3 types of market sell-offs explained. Every investor eventually experiences a market sell-off. Whether you are a long-term investor, swing trader, or day trader, seeing stock prices fall can be uncomfortable. However, not every decline means the same thing. One of the biggest mistakes investors make is treating every sell-off as if it has the same cause. In reality, most declines fall into one of 3 categories: company sell-offs, industry sell-offs, and market sell-offs. Understanding which type of sell-off is occurring can help investors make smarter decisions, avoid emotional reactions, and identify buying opportunities when quality investments become temporarily undervalued. Instead of assuming every falling stock should be sold, investors who correctly identify the cause of the decline can determine whether the problem is isolated or part of a much broader trend. A sell-off occurs when investors rapidly sell shares, causing prices to decline over a relatively short period. Sell-offs can be triggered by disappointing financial results, changes in government policy, economic concerns, rising interest rates, geopolitical events, or simply changing investor sentiment. The important point is that not every falling stock signals a bad investment. Sometimes only one company has a problem. Other times an entire industry faces headwinds. In larger events, nearly every stock in the market declines regardless of individual performance. Knowing which category you're dealing with provides valuable context before making investment decisions. Just a quick reminder to please hit the like button and subscribe to the channel. Also, you can visit us on the web at investmenttees.com and use code BLOG to receive 20% off your next purchase. Type 1. Company sell-off. A company sell-off happens when investors lose confidence in a single business while the rest of its industry and the overall market remain relatively stable. These declines are usually caused by company-specific events rather than broader economic conditions. Common causes include disappointing earnings reports, lower than expected revenue, executive resignations, accounting concerns, product recalls, lawsuits, cybersecurity breaches, failed acquisitions, or reduced future guidance. Since the issue is isolated to one business, competitors often continue performing normally or may even benefit. During a company sell-off, investors focus on whether management can solve the underlying problem. If the issue is temporary, the stock may recover over time. If the problem permanently damages the company's competitive position, the decline may continue. Company sell-off example. Imagine a fictional company called ABC Electronics that manufactures smartphones. Investors expect the company to earn $2 per share during the quarter, but it reports only $1.20. Management also announces weaker sales for the next year due to production delays. As a result, the stock falls 18% in one day. Meanwhile, competitors continue reporting strong sales, and the technology sector remains healthy. The overall stock market barely moves. In this situation, the decline affects only ABC Electronics because investors are reacting to company-specific news. This is a classic company sell-off. Company sell-offs often create opportunities for investors willing to analyze the situation objectively. The key question becomes whether the company's problems are temporary or permanent. Temporary issues such as delayed product launches, short-term supply chain disruptions, or one-time legal expenses may eventually be resolved. If the company's long-term business remains strong, patient investors sometimes find attractive buying opportunities. On the other hand, if the company loses market share, faces technological disruption, or suffers serious management failures, the lower stock price may accurately reflect a deteriorating business. Successful investors separate temporary setbacks from permanent business damage. Type 2. Industry sell-off. An industry sell-off occurs when multiple companies within the same sector decline together because investors believe the entire industry faces challenges. Unlike a company sell-off, the problems are not isolated. Instead, they affect businesses that operate within the same economic environment. Industry-wide sell-offs may result from new government regulations, higher production costs, falling commodity prices, changing consumer preferences, technological disruption, or slowing demand for the industry's products or services. Although some companies within the industry may be financially stronger than others, investors often sell nearly every stock in that sector. An industry sell-off example: suppose oil prices suddenly fall by 30% over several weeks. Investors expect energy companies to earn less money because lower oil prices reduce profits. As a result, several major oil producers decline at the same time. Company A falls 12%, Company B falls 15%, and Company C falls 18%. Meanwhile, healthcare companies, banks, retailers, and technology stocks remain relatively unchanged. Since the decline affects nearly every company in the energy sector rather than one specific business, this represents an industry sell-off. Entire industries often move together because they share similar business conditions. For example, higher interest rates may reduce home sales, negatively affecting homebuilders. New environmental regulations may increase operating costs for energy producers. Lower consumer spending may hurt luxury retailers. Even strong companies can experience temporary declines simply because investors avoid the entire sector. Experienced investors recognize that industry-wide weakness sometimes creates opportunities to buy financially healthy companies whose long-term prospects remain intact. Type 3. Market sell-off. A market sell-off is the broadest and often the most dramatic type of decline. Instead of affecting one company or one industry, nearly every sector experiences falling prices simultaneously. Market sell-offs are usually driven by macroeconomic events that impact the entire economy. Examples include recessions, financial crises, aggressive interest rate increases, high inflation, global pandemics, wars, banking crises, or widespread fears about future economic growth. During these periods, investors often reduce exposure to risk across their entire portfolios rather than evaluating companies individually. As fear spreads, quality businesses and weaker companies may both decline together. A market sell-off example: imagine inflation rises much faster than expected, prompting the central bank to aggressively increase interest rates. Investors worry that higher borrowing costs will slow economic growth. Technology stocks decline. Banks decline. Retail companies decline. Healthcare companies decline. Industrial companies decline. Energy companies decline. The major stock indexes fall 8% over several days, with most stocks moving lower regardless of their individual financial performance. This broad-based decline represents a market sell-off because investors are responding to economy-wide concerns rather than company-specific or industry-specific problems. Although market-wide declines can feel frightening, history has shown that they often present some of the best long-term buying opportunities. When fear dominates financial markets, investors sometimes sell high-quality companies simply because they want to reduce overall market exposure. Businesses with strong balance sheets, growing earnings, and competitive advantages may temporarily trade below their intrinsic value. Long-term investors who remain disciplined often use market sell-offs to gradually build positions in fundamentally strong companies. Rather than focusing on short-term price movements, successful investors evaluate whether the underlying business remains healthy despite temporary market volatility. Before making any investment decision, investors should ask 3 simple questions. First, is only one company falling while competitors remain stable? If so, the decline is likely a company sell-off. Second, are multiple companies within the same sector falling while other industries remain relatively unaffected? If that is the case, it is probably an industry sell-off. Finally, are most sectors and major market indexes declining together? If nearly everything is moving lower, investors are likely experiencing a market sell-off. Answering these questions helps provide context and prevents emotional decision-making during periods of volatility. Experienced investors view sell-offs differently from beginners. Instead of reacting emotionally, they first determine whether the decline is company-specific, industry-wide, or affecting the entire market. This framework helps investors decide whether additional research is needed, whether patience is appropriate, or whether an opportunity may exist. A company sell-off encourages analysis of financial statements, management decisions, and competitive positioning. An industry sell-off requires evaluating broader sector trends and future demand. A market sell-off shifts attention toward economic conditions, interest rates, inflation, and investor sentiment. Understanding the context behind declining prices improves decision-making and reduces emotional investing. Conclusion: every stock market decline tells a different story. A company sell-off affects one business because of issues unique to that organization. An industry sell-off impacts multiple companies operating within the same sector due to shared challenges. A market sell-off affects nearly all industries because of broader economic or financial concerns. Recognizing these differences allows investors to respond thoughtfully rather than emotionally. Instead of assuming every falling stock should be sold, or every dip should be bought, investors can evaluate the true cause of the decline and make decisions based on facts rather than fear. Markets will always experience periods of volatility, but understanding the three types of market sell-offs provides a valuable framework for navigating uncertainty. Whether you are building a long-term investment portfolio or actively trading the markets, identifying the type of sell-off can help you better assess risk, uncover potential opportunities, and become a more confident and disciplined investor. Thanks for watching.